Hello, I'm John Najarian for CNBC PRO, and this is Trade School, where we break down exactly what happened, how did we identify unusual activity in a given stock. This stock, Tesla, on March 10th, had unusual volume, volatility, and we don't know what the catalyst was. However, when we see a spike in volume and a spike in volatility, that's telling us that maybe the people that are selling these options, whether they're calls, which these were, or puts, those people are getting afraid that maybe somebody knows something, and maybe that catalyst that they're betting on is something big enough to move the stock pretty big. So on March 10th, Tesla was $203 a share. It had come down from $210 to $203, and these options had come down. The 230 calls in April had come down from about $5.50 to $3.50, much cheaper. They stepped in, started buying a boatload of them, drove them back up to about $4, and then with stock closing right around $205 that day, a lot of folks said, John, why would you jump on these out of the money calls? Well, here's why. Take a look at Tesla today, $17 higher. It's through $220 a share. That's right around an 8% move. Meanwhile, these options tripled in value. So what did I do? Took off half. The other half, I sold the April 235 calls against them to lock in some profit and to give myself a little more upside. If Tesla makes it to 235 by the third Friday in April, that's expiration, then I'll really ring the register again, because I sold these 235 calls for $7 today against the calls that I bought last week for $3.50. I'm John Najarian for Trade School on CNBC PRO.